Hello, class. Picking up where we left off, we had calculated the income statement, we had the expenses, we did our tax expense. Now it's time to get our earnings per share. We start with basic, so we need to do our weighted average shares outstanding. We have net income, no preferred dividends to worry about. We started with 10,000 shares. That's outstanding for 3 months, January, February, March, so there's 12. Okay, so we take 10,000 times 3 divided by 12, get 2,500. Then we bought back 300 shares, and so that means that our number of shares outstanding goes down to 9,700. That was true for April, May, June, July, August, September, 7 months out of the 12. So we multiply it by 7/12 and get 56, 58. Then we resold 100 shares, so we're back up to 9,800 for November, December. So 12 months out of the year, each of them divided by 12 get 1633. So our WASO to begin with is 97.92. So we take our net income, divide by 97.92, and we get $3.57 a share for basic earnings per share. So we then need to consider diluted, and we're going to look at the stock options, that sort of thing, and the convertible preferred convertible bonds. So if you look at the number of shares for the options, the options are 1,000 total, and they have been outstanding. They've been earned 1/4 of those, so 250 options are looked at. We use the treasury stock method, so we pretend that those were used when they were exercised. And they are going to be exercised so they can buy them at $20 and the average price is $24. We multiply that by the 20. That's how much cash they would receive if the stock options were redeemed or exercised. And then we would use that money to buy back stock at $24 a share. So we would issue 250, we would buy back 208, giving us only 42 shares additionally as the net amount that would be added to the calculation of shares outstanding. Then the number of shares that we would have from the convertible bonds, remember the convertible bonds are each convertible to 20 shares of stock, and there were 2,000 of those. So you would convert them and you would end up with 4,000 more shares. However, because there was interest on those bonds that would not have to be paid, we also have to add to our numerator the interest times 79%. That's because 21% is the tax rate. So our net income goes up by that amount, and the number of shares goes up by 4,000 plus the stock options, 4,042, and we get a new, or our diluted shares outstanding of $2.75, or earnings per share of $2.75. So the adjusted net income divided by the diluted shares outstanding. And going back to our statement of equity, changes in equity, we've talked about each of these items. We did come up with our shares outstanding. At the end of the year, it was 9,800. Remember this calculation. That means we paid dividends of 4,900. So we need a journal entry: debit retained earnings and credit cash. That we didn't do earlier. That goes in this retained earnings column. Our treasury stock, here's a purchase of the treasury stock, here's a sale, here's the stock compensation. Oops, move this over so you can see it a little better. There we go, 6,000, 2,000, 10,000 common stock. Nothing changed common stock, because when we buy back shares and sell them, it affects treasury stock, not common stock. Additional paid-in capital from the stock compensation and the sale of our treasury stock, cash dividend, and the net income from up here. Then the balance sheet looks like this. You're pulling each of the balances from your T accounts based on your journal entries. There's one deferred tax asset or liability. It's always long term. In this case, the deferred tax liability was higher than the deferred tax asset. I wouldn't consider it a big deal if you had the deferred tax asset up here under assets and the deferred tax liability under liabilities, but technically under the rules, FASB says there's only one or the other, you just net them together. And then all of these numbers from our balance sheet section of the stockholders' equity section of the balance sheet come from our statement of equity. Literally, this is the explanation of how we got these numbers. So you see your balance sheet balances at 685, 393, and then we asked for the cash flow using the indirect method. This harkens back way back to about the fourth week of the semester. Our net income we start with, we add back our non-cash expenses. We had two of them, depreciation, compensation expense, our changes in current assets and current liabilities, change in deferred tax liability is an operating liability. So these are all operating assets or liabilities, which sometimes can be described as current assets and current liabilities, although that's not exactly the same thing. You can make that assumption. Deferred tax liability is always a operating liability. And then we have the financing, the payments we made on the note, purchase of the treasury stock, sale of treasury stock, all goes under financing. It's not investing. In fact, we had no investing transactions at all. The new convertible bonds, dividends, we know what that is. And then probably the hardest one is the two payments on the lease minus the interest is what you have to look at as far as how much you pay off of the lease. So that's kind of on your finance lease, that's how much you paid off of the lease during the year. And because we paid $3,000 towards the lease, and then we increased our interest on the lease by the $693. So that's the difference. So that gives us a change in cash of $229. We started with $4,000, we ended with $233. Perfectly balances and equals out to match the balance sheet. So, no, it was a pretty involved problem, but if you break down each one piece at a time and take it, individually, it's not too bad. If you try to take it on all at once, it can get kind of difficult and overwhelming. You're going to do very much the same thing for the next year for the test. You're going to start with the ending balances for this year. So your beginning cash is going to be $233. All the assets, liabilities, equity accounts go forward, and you have the new beginning balances, and all the income statement expenses, revenues, they all start over at 0. All right, and remember, you should start the new year with retained earnings matching what your balance sheet is, 126,846. And there should be nothing in your revenues and expenses. And that will get you going on the exam for the next year. You'll do some of very similar journal entries in order to accomplish that.